Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is we'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they are influential people, and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you will discover, and hopefully it will give you a wide and useful perspective. With that out of the way, let me get started. See, when Trump began announcing his tariffs, we at markets lost our minds for a bit. That was a sudden reversal of the way the world economy ran for decades, and we found ourselves writing a series of frantic pieces trying to understand what this all meant. But now that a 50% tariff is actually in place, we don't really know what to say. We have no way of analyzing what happens when the world's largest market slaps double-digit tariffs at a whim. The thing is, this isn't a serious economic diplomacy, but it's a shakedown. And lately, it seems like India has become Trump's biggest punching bag. See this post, for instance. In the world of social media, where most of Trump's policymaking happens, it's easy to point fingers at someone and scream Russia. It's infinitely harder to explain complex nuances of geostrategy. India has tried though, putting out a fairly strong statement with its point of view. Now, will this convince anyone to see India's point of view? Of course not. But it's worth digging into this response, if only to understand India's perspective on what is genuinely a complex issue. To begin that, here's a simple fact. America never tried to ban countries from importing Russian oil. Instead, it went for a price cap of $60 per barrel of Russian oil. In case you're wondering, countries basically never put price caps on each other. Think of how odd a choice it is. The West was telling Russia the price it could sell its oil to completely unrelated third parties. Why choose something so weird? Why not just cut Russia out completely? See, it's simple. If it cuts the world's third biggest oil producer out of the global market, there would be chaos across the world. This is what the US Treasury said back in 2022. It basically said that the price caps keeps Russian oil in global markets at reduced prices, cutting Russia's war revenues. It mainly helps developing countries access cheaper energy while protecting them from price shocks. But it's worth noting two things here. One, that price cap was designed to maintain the flow of Russian oil. And two, that it was meant to be of particular benefit to emerging markets. The plan in short was to ensure that Russian oil kept flowing into the world, but that it didn't get to make any profit from it. India was very much a part of this plan. It was one of those that the US then hoped would gobble up Russian profits. As US Treasury Secretary Janet Yellen had said back then, if they want to use Western financial services like insurance, the price cap would apply to their purchases. But even if they use other financial services, we believe the price cap will give them leverage to negotiate good discounts from world markets. We would hope to see India benefiting from this program. Now, this wasn't charity, of course. India is the world's third largest importer of oil. Even if we didn't buy oil from Russia, we would buy oil. If not Russia, we would go to the same markets that Western powers would, the Middle East, the Americas, and so on. That would inevitably push prices higher in all those markets, making things harder for Western countries. Now, it doesn't stop there though. See, there's a funny thing about international trade. If India buys Russian crude oil, refines it, and sells you diesel, the diesel isn't considered Russian. It's considered Indian diesel. It might have started in Russia, but going through Indian refineries magically changes it. Or that's at least what many countries choose to think. Because the world's G7 countries have been happy to buy Russian oil once it has gone through Indian or Turkish refineries. According to analysis by KRIA, between March 2024 and February 2025, G7 countries imported $9 billion worth of petroleum products from the two countries which were refined from Russian crude oil. Although the European Union is finally cracking down on some of this. Now, did Indian purchases of oil directly fund the Russian military? Most probably. But India's contention is that we are being turned into a scapegoat. The rest of the world, the West included, was willing to pay Russia for their own imports. As the MEA pointed out, last year 67.5 billion euros entered Russia too, and more perhaps channeled into Russia via India. This was all by design. It hardly makes sense to point fingers at one country. Now we want to be fair here. See, countries are allowed to change their mind and withdraw their plans. Countries that are trying to stop endless wars often do. And India didn't just buy oil out of necessity, it made windfall profits for a long time by refining Russian oil. But it makes little sense to paint India as some sort of rogue nation. Everyone knew what a price cap would do. If your primary foreign policy tool was to make Russian oil cheaper, it hardly makes sense to complain when people buy more. That was indeed the plan. When the West first chalked out this scheme, it was trying to find win-win solutions for its partners and doing so maintain global stability. Trump, it appears, cares for neither. Now, if you've been reading the Daily Brief lately, you might have come across our story on the diamond monopoly, De Beers. I absolutely enjoyed doing such an exciting piece looking into how technology, markets, and geopolitics are eroding the power of one of the most powerful cartels in human history. And we've been obsessed with it. In 2 decades, lab grown diamonds are completely changing the structure of an industry that is almost 2 centuries old. However, one country hasn't fully bought into the hype of lab grown stones: India. In a recent CNBC TV18 interview, Ajay Chawla, the CEO of Titan, which owns Tanishq, wasn't bullish on lab-grown gems. Tanishq isn't willing to fuel lots of resources on them because its customer want the real stuff.
We felt it is important that we need to educate customers and empower them. Let them know what they are buying and let them understand the value of what they are buying.
As of last year, Tanishq had no plans to enter the space. That hasn't changed at all. Rather, they are doubling down on natural diamonds, in partnership with none other than De Beers themselves. Tanishq has established diamond expertise centers which help them figure out natural diamonds from lab grown ones. Tanishq wants its customer to have an abundance of choices. Indian customers like natural diamond not because they are real, but because, like gold, they are long term investments. But ironically, natural diamonds became popular as valuable investments primarily because that same abundance was artificially restricted by De Beers.
So we think it's a great opportunity, and we believe that the launch of the Tanishq Diamond Expertise Center will not only build empowerment, but will also strengthen the trust, not just in Tanishq, but in the category of diamonds.
While Indian demand for lab grown diamonds, only 2% of India's total diamond market, has been increasing, it is nowhere as fast as the Indian natural diamond market, which has surpassed China to be the second largest in the world. Al Cook, the CEO of De Beers, believes that India's natural diamonds market will double by 2030. But customer demand isn't the only cause of this sentiment. The margins are tight in the lab grown market too. Ajay Chawla highlighted that many players have entered the lab-grown market, which has led to a situation of excess supply. As a result, the market price of lab-grown diamond has fallen, putting pressure on profitability.
Very recent phenomena, there are many players who've jumped in. Prices have been dropping significantly. Hopefully in the future, penetration of diamond-studded jewelry in the country will go up because of that.
See, competition is very intense in the lab-grown market. In comparison to natural, mined diamonds, which need huge upfront investments in mining, it is not hard to start making lab-grown gems. But that means lots of players are fighting for the same slowly growing pie. There is lots of uncertainty on both who the winners and losers of this competition will eventually be and how they will emerge. However, what may be true today may not be so tomorrow. Is it really wise for Tanishq to be cutting their teeth deeper into natural diamonds? De Beers has already run into a whopping $189 million loss in the first half of 2025. India might be one of their very few bright spots. Surat, a major hub in the global diamond supply chain, is collapsing, partly because natural diamonds have lost their sheen among buyers. What is also true is that the entry of a big giant like Tanishq could actually reduce the amount of uncertainty in the market. However, they are yet unwilling to risk money into both investing in lab-grown production as well as educating customers about the merits of lab-grown stones, just like how De Beers advertised natural diamonds. Something major has to happen for them to make the shift. Given how lab-grown gems have evolved, sooner or later, the time might just come. Just last week, the design company Figma had a blockbuster IPO, jumping from $33 on the opening of day 1 to closing of $115.5, valued at over $60 billion on its debut. a startup success story for the ages that made many people very wealthy. However, the IPO has created some spicy drama and debate in Silicon Valley because an interesting person, neither a Figma investor nor an employee, took credit for the success. Her claim was that the IPO can be directly attributed to the US anti-monopoly laws that protect startups and consumers from the abuse of power by large firms. And she was once at the very forefront of executing these laws. That person was none other than ex-FTC chairperson Leena Khan. To understand why she said this, let's roll the clock back 3 years. In 2022, design software giant Adobe wanted to acquire the upstart Figma for a whopping $20 billion. That was a deal that both sides were incredibly happy about. It would help Adobe increase their strength in the design software while Figma shareholders were being offered a great price on their shares. A win-win. However, the anti-monopoly bodies of the US, then led by Leena Khan, and Europe were pissed. They saw this deal not as a win-win, but one where Adobe wanted to eliminate competition. Such deals are often called killer acquisitions. Adobe and Figma spent the next year trying to convince them otherwise. However, strict conditions were put on the deal's approval. For instance, Adobe was required to sell off Figma's design product, the core offering that Adobe was likely buying it for. This didn't make sense and the deal was eventually abandoned. In its aftermath, Figma went through a small rough patch. It had to reset its valuation to $10 billion, half of Adobe's offering. Many employees and investors who owned shares wanted to quit or exit their stake quickly after such a disappointing outcome. An IPO which Figma wasn't even thinking about seemed further away with lower market confidence in their valuation. Now all of this brings us to the key issue under debate. There is no way to predict with 100% certainty that Figma's IPO would have been successful. Startups carry lots of risk and the founders and investors need the promise of a reward to take that burden. But they don't really expect to IPO when they are fighting for survival every day. For every one Figma, there are thousands of startups that have died prematurely. But a big firm like Adobe could save and reward them on time. One may argue that regulatory crackdown on the Figma Adobe deal was better in the long run, but we can only conclude this in hindsight. What if Figma went bankrupt because of such government intervention? These were the points raised by the founder of legendary startup incubator Y Combinator, Paul Graham. Many other famous investors said the same thing, but with a lot more anger. On the other hand, Leena Khan's side understands this risk too, but in different ways. They believe that it is worth stopping such deals that may monopolize the economy and give consumers less choice. Their strategy might increase the risks for early stage startups, but they are okay with it as long as one success like Figma compensates for the others that died. Two sets of people operating with the same principles of risk but with different views. That's it for this episode. If you have any feedback for me, please let me know in the comments below. As US Treasury Secretary, as US Treasury Secretary,
2,000 years later.
As US Treasury Secretary Janet Yellen,
Tomorrow for sure.
as the US Treasury Secretary,
Eventually.
As US Treasury Secretary, as Janet Yellen,
One extremely annoying shift later.
as Janet Yellen, the US Treasury Secretary.